Welcome to Voice on Pages. Let's find out about the 2008 financial crisis and what the intelligent investor can teach us about it with a fresh and new perspective. In 2008, the world watched as banks collapsed, stock markets crashed, and millions lost their homes and jobs. But what if I told you that Benjamin Graham, the father of value investing, had already given us the playbook to avoid the worst mistakes? Today, we'll uncover the timeless lessons from the intelligent investor that could have protected you then and can still protect you now.
I mean, just think about that sentence. It's so prophetic, right? Graham wasn't just predicting some downturn. No, decades before 2008, he was basically laying down a fundamental law of the market. The party always ends. The real question is, are you ready for the hangover when it hits?
And man, that hangover was brutal. For so many of us, 2008 isn't just some date in a history book. It's a memory we can feel. You remember the headlines, the fear, the real-world impact. It was like a global shockwave that just shattered our trust and left some pretty deep scars.
But here's what's so wild about all this. The crisis wasn't caused by some crazy, unpredictable, once-in-a-lifetime event. Nope. When you boil it all down, it was a failure of the most basic stuff. Discipline, common sense. It was a deeply, deeply human failure.
And it all started with this one dominant belief. Housing prices never fall. I mean, if they only go up, where's the risk, right? That one simple, incredibly dangerous idea fueled the entire thing. It became like a religion, justifying everything from families taking on loans they couldn't possibly afford to Wall Street bundling them up into these crazy complex things nobody really understood. This single illusion was basically the gasoline on a bonfire of speculation.
In this slide, this really shows you the emotional roller coaster that drove the whole bubble. It all kicked off with some simple confidence back in 2002. That confidence morphed into pure excitement by 2005. And by early 2007, we hit total euphoria. That's the peak, right? The point where everyone's delusional and thinks the party will never stop. But of course it did. And when it did, fear crept in. And by 2008, that fear had just spiraled into absolute market-destroying panic.
So here you can see the two mindsets, side by side. On one hand, you have the 2008 mindset, which was just pure herd mentality. Everyone was terrified of missing out. They were riding that emotional pendulum we just talked about all the way up to that euphoric peak. But Graham's reality? Well, the intelligent investor stands apart from that crowd. They know the pendulum always swings back, and they're just waiting patiently for that moment of total pessimism to start buying from the panicked herd.
And this is the devastating result. We're not just talking about numbers on a screen. The collapse of the housing and stock markets literally wiped out the retirement savings of millions of ordinary families. The trust people had in the whole financial system was just shattered. The human cost was absolutely immense. So the big question is, how could all this have been avoided? And what's so fascinating is that the antidote, it was already out there. Decades earlier, Benjamin Graham's playbook laid out a clear, rational way to navigate all this market madness.
Okay, at the absolute core of Graham's entire philosophy is this one idea, the margin of safety. Now, this isn't about trying to predict the future. It's about building a buffer that protects you because the future is unpredictable. It is, no joke, the secret to smart investing boiled down to just 3 words.
So how does it work in practice? Well, it's a really simple defensive move. Step 1, you do the homework to figure out what a business is really worth, totally separate from its stock price. Step 2, you wait, with discipline, until you can buy it for way, way less. That gap between the value and the price, that is your margin of safety. It's your shield against bad luck, bad timing, and even your own mistakes.
And this brings us to maybe Graham's most critical distinction, investment versus speculation. See, an investment, he says, is based on solid analysis. It promises that your initial money is safe and you'll get a decent return. Anything else is speculation. So by that definition, buying a house with 0 money down, just hoping to flip it in a year, that wasn't investing. That was a pure gamble that prices would keep going up. And, well, we all know how that turned out for millions of people. All right, to help us get a grip on our emotions, Graham gives us one of the most brilliant metaphors in all of finance. He asks you to imagine you have this business partner. His name is Mr. Market. And he's not your friend or your guide. He's this wild character you have to learn how to manage. And let's just say Mr. Market is a little unstable. He shows up every single day offering to either buy your shares or sell you his. But the prices he's quoting, they're all over the map. They're driven by his wild, manic-depressive mood swings, not by the actual, real value of the business. When he's in one of his euphoric moves, think 2007, he'll offer you a ridiculously high price to buy your assets. That's your cue to sell. But when he's in despair, like in late 2008, he'll practically beg you to take his shares for pennies on the dollar. And that's your cue to buy. You see, his mood swings are what create your opportunities.
So here's the key takeaway about Mr. Market. You never have to trade with him, ever. You don't work for him. He works for you. You can listen to what he has to say, but you have to think for yourself. So the question is, are you going to let his panic become your panic, or are you going to use his foolishness to your advantage? And this, honestly, might be Graham's single most important lesson of all. The real fight isn't with the market, it's with yourself. It's with your own impulses. Your success as an investor has less to do with how high your IQ is and everything to do with your emotional discipline. It's about your character, not just your brain. When you put all this together, it totally changes your mindset as an investor. You start to see market crashes not as scary threats, but as predictable, even welcome opportunities. You stop trying to guess the market's next move. Instead, you just focus on what you can actually control, finding a good business and buying it at a fair price. Everything else is just noise. The 2008 crisis wasn't just a failure of banks. It was a failure of discipline, risk management, and financial wisdom. The intelligent investor reminds us that success doesn't come from timing the market or chasing trends. It comes from patience, discipline, and protecting yourself with a margin of safety. So next time the market shakes, ask yourself, am I acting like a speculator or an intelligent investor? Share your thoughts in the comments. Do you think another 2008-style crisis could happen again?
And don't forget, like, share, and subscribe so these lessons reach more people who need them.